Welcome to this comprehensive introduction to financial ratios. These powerful analytical tools are indispensable for anyone seeking to understand the true financial health and performance of a company. They provide a standardized framework for evaluating complex financial data. The primary purpose of financial ratios is to assess a company's financial performance and overall health. They transform raw numbers from financial statements into meaningful insights. This allows for a clearer picture of operational efficiency and financial stability. Financial ratios offer a standardized way to compare a company's performance. This comparison can be made over time, allowing for trend analysis to identify patterns and changes. It also enables direct comparison against competitors within the same industry. Furthermore, ratios are crucial for benchmarking against industry averages and best practices. The insights gained from ratio analysis are multifaceted. They help in identifying a company's strengths, such as strong profitability or efficient asset utilization. Conversely, they can highlight weaknesses, like excessive debt or poor liquidity. Ultimately, ratios provide a holistic view of a company's overall financial standing. Various key stakeholders benefit significantly from financial ratio analysis. Investors use them to make informed investment decisions, assessing risk and potential returns. Creditors rely on them to evaluate a company's ability to repay loans. Management teams utilize ratios for strategic planning, performance monitoring, and operational improvements. Financial ratios are fundamentally defined as mathematical relationships. They are derived by connecting different line items found within a company's financial statements. This process quantifies specific aspects of a business's operations and financial position. The primary financial statements used to calculate these ratios are the balance sheet, the income statement, and the cash flow statement. Each statement provides unique data points essential for different types of ratios. The balance sheet offers a snapshot of assets, liabilities, and equity at a specific point in time. The income statement details revenues, expenses, and profits over a period. The cash flow statement tracks the movement of cash into and out of the business. Ratios are systematically categorized into key areas, each focusing on a distinct aspect of financial performance. This categorization helps in organizing the analysis and understanding specific facets of a company. Each category offers a unique perspective on a company's operations, from its ability to generate profit to its capacity to manage debt. Profitability ratios are designed to measure a company's ability to generate profits from its sales, assets, or equity. They are crucial indicators of a company's operational efficiency and overall financial success. These ratios help stakeholders understand how effectively a company converts its revenue into profit. Key examples include the gross profit margin, operating profit margin, and net profit margin. The gross profit margin indicates the percentage of revenue left after deducting the cost of goods sold. It reflects the efficiency of production and pricing strategies. The operating profit margin shows the percentage of revenue remaining after covering both the cost of goods sold and operating expenses. This ratio highlights the efficiency of core business operations before interest and taxes. The net profit margin represents the percentage of revenue left after all expenses, including taxes and interest, have been deducted. It is a comprehensive measure of a company's overall profitability. These ratios collectively reveal a company's efficiency in managing costs and generating revenue. They indicate the ability to convert sales into actual profit for shareholders. Liquidity ratios assess a company's ability to meet its short-term obligations. These obligations are typically due within 1 year. They are vital for understanding a company's immediate financial health and its capacity to cover current liabilities. Commonly used examples include the current ratio and the quick ratio. The current ratio compares current assets to current liabilities. It provides a general indication of a company's ability to pay off its short-term debts. A higher current ratio generally suggests better short-term financial health. The quick ratio, also known as the acid test ratio, is a more conservative measure of liquidity. It excludes inventory from current assets, as inventory can sometimes be difficult to convert quickly into cash. This ratio highlights a company's capacity to pay off debts as they come to using its most liquid assets. It provides insights into short-term financial stability, indicating whether a company can handle unexpected cash demands. Solvency ratios evaluate a company's long-term financial stability and its ability to meet long-term obligations. Unlike liquidity ratios, which focus on short-term capacity, solvency ratios look at a company's financial structure over an extended period. They are critical for assessing a company's resilience and its capacity to sustain operations. Crucial examples include the debt-to-equity ratio and the debt-to-asset ratio. The debt-to-equity ratio compares a company's total debt to its shareholder equity. It indicates the proportion of financing that comes from creditors versus shareholders. A high ratio suggests a greater reliance on debt financing, which can imply higher financial risk. The debt-to-asset ratio measures the proportion of a company's assets that are financed by debt. It provides another perspective on how much of a company's assets are owned by creditors. These ratios reveal a company's reliance on debt financing and indicate its financial risk. They also offer insights into a company's resilience to economic downturns and its long-term viability. Efficiency ratios, also known as activity ratios, measure how efficiently a company utilizes its assets to generate sales and revenue. They provide insights into the operational effectiveness of a business. These ratios are crucial for understanding how well a company manages its resources. Examples include inventory turnover, accounts receivable turnover, and asset turnover. Inventory turnover measures how many times inventory is sold and replaced over a period. A higher turnover generally indicates efficient inventory management and strong sales. Accounts receivable turnover assesses how quickly a company collects its outstanding credit sales. A higher turnover suggests effective credit policies and collection efforts. Asset turnover measures how efficiently a company uses its assets to generate sales. It indicates the amount of sales generated for each dollar of assets. These ratios provide insights into the effective management of inventory, receivables, and overall assets. They highlight a company's operational efficiency and its ability to maximize resource utilization. Valuation ratios are primarily used to assess the market value of a company's stock. They are particularly important for investors looking to determine if a stock is fairly priced. These ratios help in comparing the market price of a company's shares to its financial performance. Commonly used examples include the price-to-earnings (PE) ratio and the price-to-book (PB) ratio. The PE ratio compares a company's current share price to its earnings per share. It indicates how much investors are willing to pay for each dollar of earnings. A high PE ratio might suggest that investors expect higher future growth. The PB ratio compares a company's market price per share to its book value per share. Book value represents the net asset value of a company. This ratio helps investors determine if a stock is overvalued or undervalued relative to its assets. Valuation ratios provide insights into market sentiment and a company's investment potential. They are essential tools for making informed investment decisions. Financial ratios are crucial for making informed financial decisions across various stakeholders. They enable a comprehensive understanding of a company's financial performance, moving beyond raw numbers to reveal underlying trends and relationships. This analytical depth is vital for strategic planning and operational adjustments. These ratios help identify potential risks, such as declining profitability or excessive debt, before they become critical issues. They also highlight opportunities for improvement, such as optimizing asset utilization or enhancing liquidity. By providing clear, quantifiable metrics, ratios facilitate strategic and effective decision-making. They empower management to steer the company toward its financial objectives. It is imperative that ratios must be analyzed in context. A single ratio in isolation provides limited insight. Instead, analysis should consider broader industry trends, as performance benchmarks vary significantly across sectors. Economic conditions, such as recessions or periods of growth, also heavily influence financial performance and ratio interpretation. Finally, a company-specific business model and operational strategies must be factored into the analysis. A high debt ratio might be acceptable for a capital-intensive industry, but concerning for a service-based business. Understanding these contextual factors ensures that ratio analysis leads to accurate and actionable conclusions, truly unveiling a company's story.